Welcome to today's video on conquering the Roth IRA income limit as a high earner. In this session, we'll cover practical strategies to maximize your retirement savings, reduce taxes today, and create tax diversification for the future. Let's dive in and structure your plan step by step. You've hit the income threshold where direct Roth IRA contributions are phased out. Instead of seeing this as a setback, see it as a chance to optimize. In this video, we'll explore how high earners can use pre-tax 401k and the Backdoor Roth to maximize savings and flexibility. First, let's preview what we'll cover. Here's the roadmap. We'll start with the tax rate dilemma between traditional and Roth. Next, we'll focus on reducing modified adjusted gross income using pre-tax 401k contributions. Then we'll unpack the Backdoor Roth IRA process. After that, we'll discuss the critical Pro-Rata Rule to avoid pitfalls. We'll conclude with the combined strategy of doing both and finish with an action plan and a short quiz to reinforce learning. Before we proceed, please note that this video is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique, so consult a qualified professional before implementing any strategy. With that said, let's move forward to the key tax dilemma that frames your decisions. Let's address the tax rate dilemma. If you are in the 24% or higher bracket, you often benefit most by prioritizing traditional pre-tax contributions first. This is because you receive a guaranteed immediate tax deduction, which puts more money in your pocket today. While it's impossible to predict future tax rates accurately, the immediate savings are real and investable. Still, Roth accounts remain powerful due to tax-free growth and flexibility. To leverage both, we'll need a clear order of operations. Next, let's reduce your modified adjusted gross income to potentially regain direct Roth eligibility. This flowchart illustrates the practical path. You begin as a high-income earner. First, you maximize traditional 401k contributions to reduce current taxes and lower your MAGI. Next, you check whether your MAGI is now below the Roth IRA eligibility threshold. If it is, you make a direct Roth IRA contribution. If it is not, you proceed with a Backdoor Roth IRA. However, before executing the backdoor, you must check for any existing pre-tax IRA balances such as traditional, SEP, or simple IRAs. If those exist, the Pro-Rata Rule would cause a portion of your conversion to be taxable. In that case, many investors roll those pre-tax IRA funds into an employer plan to clear the IRA balance before the backdoor. The finishing step is to do both every year. Maximize your pre-tax 401k and add Roth dollars directly or via backdoor for diversification. Now let's focus on modified adjusted gross income, or MAGI. MAGI determines whether you can make a direct Roth IRA contribution. Pre-tax 401k contributions reduce MAGI dollar for dollar and should be prioritized first. In many cases, maxing your pre-tax 401k may bring your MAGI under the Roth eligibility threshold, allowing a direct Roth contribution. Even if you remain over the limit, you still receive immediate tax savings and can then use the Backdoor Roth pathway. The visual mind map shows common levers such as pre-tax 401k, health savings accounts if eligible, flexible spending accounts, charitable strategies like donor-advised fund bunching, and in some cases, business-related adjustments. Next, let's break down the Backdoor Roth step by step. Here is a clean annual checklist. First, maximize your pre-tax 401k. Second, evaluate your MAGI against Roth eligibility. If you are under the limit, contribute directly to a Roth IRA. If you are still over the limit, execute a Backdoor Roth by making a non-deductible contribution to a traditional IRA and converting it to Roth soon after. Before converting, verify that you have no pre-tax IRA balances that would trigger the Pro-Rata Rule. Finally, repeat this cycle annually to build both tax-deferred and tax-free buckets. Coming up, we'll detail the backdoor mechanics. The Backdoor Roth consists of two steps. You make a non-deductible contribution to a traditional IRA and then convert that amount to a Roth IRA. Executing the conversion shortly after the contribution helps minimize any taxable earnings that might accrue in the interim. Keep accurate records and ensure your basis is tracked on the appropriate forms so the non-deductible portion is not taxed again. This process can be repeated each year to continue adding to tax-free growth. Next, we'll visualize the flow with a sequence diagram. This sequence diagram walks through each interaction. You contribute a non-deductible amount to a traditional IRA and confirm that your basis is tracked. Next, you convert those funds to a Roth IRA, ideally quickly to reduce potential taxable earnings. The Roth IRA and you both effectively report to the IRS. You will file the appropriate form to document basis so the non-deductible amount is not taxed again. The key operational point is to minimize the delay between contribution and conversion. On the left is the traditional side. You receive an immediate deduction, potentially pay lower taxes if your retirement withdrawals fall in lower brackets, and you reduce MAGI, which can help with Roth eligibility. This often makes sense for high earners who value immediate savings. On the right is the Roth side. While there is no deduction up front, you get tax-free growth and qualified withdrawals, no required minimum distributions for the original owner under current rules, and valuable flexibility if future tax rates are higher. The backdoor approach allows high earners to continue adding Roth dollars despite income limits. The Pro-Rata Rule taxes your Roth conversion proportionally across all your IRA balances as of the end of the year. If you have any pre-tax IRA money, such as in traditional, SEP, or simple IRAs, then part of your conversion becomes taxable. This can undermine the advantage of the backdoor. Many investors address this by rolling pre-tax IRA balances into their employer's 401k plan before attempting a conversion. The practical goal is to have a zero pre-tax IRA balance on December 31st of the conversion year to avoid the pro-rata proration. Next, let's add a timeline for your annual rhythm. This timeline lays out an annual cadence. Early in the year, plan contributions and confirm whether you have any pre-tax IRA balances. Throughout the year, maximize your pre-tax 401k through payroll deferrals. Often, after bonuses or early in the year, you can complete the backdoor Roth by contributing and converting promptly. During tax filing, ensure the basis is correctly reported. Near year-end, verify your MAGI status. Make last-minute adjustments if needed, and confirm that your pre-tax IRA balances are zero before December 31st. Here are common levers that can help reduce your MAGI and potentially restore eligibility for direct Roth contributions. Traditional 401k deferrals are often the largest lever for employees. Health savings accounts, if you're eligible, offer pre-tax contributions and additional tax advantages. Flexible spending accounts and dependent care accounts reduce taxable income via payroll deductions. Charitable strategies such as bunching contributions or using donor-advised funds can amplify itemization. Finally, business retirement plans can provide substantial pre-tax contributions for self-employed individuals. Next, let's present the core formulas and order of operations in a concise Markdown guide. Here is a Markdown-style quick reference. The recommended order is to maximize your traditional 401k, check your MAGI against Roth limits, and if you are over those limits, perform a backdoor Roth by contributing to a non-deductible IRA, converting to Roth, and reporting basis correctly. Confirm that you have zero pre-tax IRA balance on December 31st to avoid the pro-rata rule. As quick checks, remember that MAGI is the gatekeeper. Minimize the time between contribution and conversion, and document your basis carefully each year. Now, let's test your understanding with a short quiz. Quiz time. The question is, which action most directly reduces MAGI for a high-earning employee and should usually be done first? The options are A. Direct Roth IRA contribution, B. Traditional 401k pre-tax deferral, C. Taxable brokerage investment, or D. Roth 401k contribution. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Traditional 401k pre-tax deferral. Pre-tax deferrals reduce your MAGI directly, which can help you regain eligibility for direct Roth contributions while providing immediate tax savings. Second quiz question. Before doing a backdoor Roth conversion, which account balance can trigger the pro-rata rule and complicate taxes? Options are A. Roth IRA balance, B. Taxable brokerage balance, C. Any pre-tax IRA balance such as traditional, SEP, or simple, or D. A 529 college savings balance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Any pre-tax IRA balance such as traditional, SEP, or simple IRAs. These balances trigger the Pro-Rata Rule, which causes your conversion to be taxed proportionally. The practical solution is to ensure a zero pre-tax IRA balance as of December 31st of the conversion year, often by rolling those funds into an employer plan before the conversion. The core takeaway is to do both. Maximize your traditional 401k for immediate tax savings, then add Roth dollars either directly if eligible or via the backdoor if not. Avoid the pro-rata complication by clearing pre-tax IRA balances before you convert. Repeat this process annually to build both tax-deferred and tax-free buckets. This combination gives you greater flexibility and control over your tax burden in retirement. This pie chart shows 3 key sources of retirement income: tax-deferred accounts like traditional 401k and IRA, tax-free accounts such as Roth IRA and Roth 401k, and taxable brokerage accounts. Having a mix across these buckets provides tax diversification. In retirement, you can pull from the most favorable bucket depending on current tax conditions, which helps manage your overall tax liability. To summarize, begin by maximizing pre-tax 401k contributions to reduce MAGI and secure immediate tax savings. Next, assess Roth eligibility. If you remain above the threshold, execute the Backdoor Roth promptly. Eliminate pre-tax IRA balances before converting to avoid the Pro-Rata Rule. Repeat this process annually to do both and achieve tax diversification. Finally, document your basis and file the appropriate forms correctly each year. We're almost done. Let's close with a quick message. Thanks for watching. If you found this helpful, please like this video, share it with a friend who could benefit, and subscribe for more strategies. Post your questions and your wins in the comments so we can learn together. See you in the next video.